Oh, hey folks, welcome back to the channel. This is Jason, host of Fighting Words Financial. Did some few updates on my system, so let me know if you guys can hear me out there. Did want to go ahead and address an early comment from Yuck. It looks like Yavuz uh, Bolokbashi, host, and uh, uh, I'm looking forward to covering this as you get the air here. So no problems doing that. We'll do that a little bit later in the live stream. But I wanted to talk about SoFi today in some sort of under the radar news that's seriously important and is going to have a lot to do with whether or not SoFi is going to be profitable by the end of the year. So I've shared this with people in my Discord group. Just not. I'm probably not going to share all of my thoughts here publicly. My Discord group gets a little bit of my more unfiltered thoughts. That's through my Patreon. But I feel that SoFi is going to be profitable before the fourth quarter. They're basically predicting that they will be profitable by fourth quarter. I think that the $2 billion in revenues that they're planning to make this year that they gave us forward guidance is likely to be exceeded meaningfully by 10% or more. A lot of that has to do with they're going to be making so much more money this year just based on cost savings that's going to take a significant portion of that excess 25 to 30% earnings that they were predicting when they last reported, right? So that's kind of my bottom line here is that they're basically going to save somewhere upwards of $200 million a year just in what's called cost of funds. So originating funds in order to turn them around and loan them out. They're going to make an additional or save about $200 million in cost through that. Additionally, asset sales, while initially it doesn't mean a great deal of actual revenue over the actual cost of the loans that they put out. What it does mean that in terms of present value of the money that they're receiving, and then they're able to turn around and loan that out again at a higher interest rate, it means that that is going to be growing significantly throughout the year. And that's probably going to account for a minimum of another 180, $200 million in savings right there. So in that way, I think that SoFi is really sort of underplaying profitability by Q4, and barring some sort of additional acquisition costs or something like that, we're probably going to see them report profitability early, and it could come shockingly early. And I want to talk about what's going on. So this article right here, analysts pound the table on SoFi stock. I can tell you right now that this is already being reported inaccurately on Reddit, and there's this long discussion on it where no one actually understands what's going on. So let's talk about what's going on today. This can be considered kind of a boring topic by some people. I do talk about fixed income sometimes on this channel, and every time I talk about it, I lose subscribers. But it's actually seriously important, especially for any company involved in this business. You don't keep loans on your balance sheet. It's just a liability at that point, even though it's generating some interest income. You take the seasoned loans that you have, meaning loans that you have been receiving payments on for 18 to 24 months. You package those up into securities that's facilitated by an investment banker, and you sell those. Sometimes in the primary market, it goes right to institutional investors, and sometimes they show back up on the secondary market. We are not going to get a chance to see this latest SoFi offering until it hits the secondary market, and we are not going to be buying it at a discount. We're going to be buying it at a pretty big premium compared to what institutional investors are going to get. And let's talk about that. Oh no. So the article is all of a sudden behind a paywall, but I can talk about it because basically I haven't completely memorized. And I pulled up the customer loan program documents here. So essentially, SoFi is going to be issuing at a par value, at a face value of $300 million, $440 million in loans. It's already got a pre-sale rating of AAA. The interest rate is fixed on that. Yield to maturity is right around 5.8%. So they're going to be selling $340 million of loans at this point. And here's a few things that are very, very interesting about these issues. This isn't unique for Smith. It's something they've done numerous times, and that's just that least for things that are going on pretty high up on the credit quality. And for some reason, my uh, if that here. All right, so I look still trying to pull along. $140 million. Why would you sell $440 million in loans for $340 million? It has to do with a couple of different things. Number one, you have something called excess collateralization, meaning that you're selling the loans right now for its present value based on what it's going to be worth in whatever this loan portfolio matures, which is in 2031. So you're selling $340 million is your par price for that security right now. It's going to, by the time everything pays off, it's going to be you're going to get the principal back of $440 million plus the coupon rate of 5.81%, which is a yield to maturity of about 5.88%. And if we look at the estimated price right here for the pre-sale, it's at 99.99846, meaning there's virtually no spread in this whatsoever. There's going to be a lot of demand for this. It's already got ratings from S&P. It doesn't have Moody ratings, but everyone basically is rating this as AAA. And you're looking at basically the sacrifice that you are making in terms of what you're accepting or what you're paying for in terms of present value, plus the additional risk of default that the investors are going to be assuming. This is not going to be SoFi assuming this risk anymore. You're getting about 77% equity in this when you purchase that at this point, meaning that it's over collateralized by a bit. So, and this is not out of line when you consider previous issues. Now, take a look at these dates down here. I don't know if you guys can see this. But back in 2018, they had 4 issues in that year. In 2019, they had 4 issues. 2020, they had a single issue. 21, a single issue. 22, a single issue. And that's when it started to look pretty good again. And then here again in 23. SoFi has about $5.1 billion available right now for securitization. I would not be surprised if we don't see 3, possibly even 4 of these issues this year, coming somewhere close to about $1 billion of loans that are securitized. So I worked through in my my Discord group today kind of what I expect for immediate profits on these and how these funds are going to be turned around and loaned back out on even higher interest rates, and how this is just sort of a positive feedback loop or snowball effect, and how all of this goes towards contributing towards profitability. We're not even talking about eventual profitability here. We're talking about profitability for SoFi, likely before Q4, based on those 2 things that I was talking about. Number one is cost savings on the cost of raising money. They can do that in 2 ways now, through security sales and through increased customer deposits at their bank, where there's a much greater spread. They're saving about 190 basis points on that. If they did no increase in volume of loans by the end of the year, meaning they did exactly what they did last year, they're going to do this year in terms of volume of loans and business. They made 0 improvements on the technology side, 0 improvements on the financial services side, and loans were exactly the same. They're still going to hit that $2 billion in revenue. All they have to do is make a bare effort at increasing business. And not only are they going to hit guidance by the end of the year, they're likely to be profitable before they've actually given us guidance for. One of the reasons why, if SoFi wasn't as much of my overall net worth as it already is right now, even with the decline, I would probably aggressively buy more shares. As it is right now, I bought a small amount of shares when it was in the 4s and the 5s and the 6s. I'm still buying a little bit here and there, but I'm not diving all the way in because I'm already at more than 12,000 shares at this point in SoFi. So if you are not on board with this stock, seriously take a look at it. Look at their overall strategy. It's not just their banking app. It's not just their financial services or their trading app or whatever. It's their entire business, particularly involving their technology platform. And the idea, and they're doing a few things a little bit differently with this trust program than they've done in the past before. And you can look at SoFi to be involved in the securitization of these loan packages going forward, not just for SoFi, but they'll probably be involved in securitizing loans for many of the other users of their fintech platform. And that's one of the things that people are missing, that you have, origination of the loans, which SoFi does, but then you have the people that create the securities, you have the underwriters of the loans, you have the trustee of the loans, you have the service of the loans. SoFi is going to be doing multiple parts of this entire step of securitizing these loans for their current clients on their fintech platform, and they're going to be taking fee income off of every step of that process. That is going to contribute to their bottom line, and it's really a long-term project for them. And I made this prediction before that 5 years from now, it's entirely possible that their technology platform income is actually greater than their lending income at this point right now. And I still believe that's true. And this, what's coming out right now only convinces me more of that. So I go through these credit reports on issues all the time, so you don't have to. But basically what they're doing now is not out of line with what they've done in the past. Over collateralization of this issue, like I said, is about 22%. The credit enhancement is about 23%. So over collateralization means just kind of the difference between the current face value of all of those loans, what you would expect to suffer in default, and the price you're paying for buying this now, which is you're buying it at close to current value. So I did the calculation in Discord on what the present day value of this future income stream is of $440 million. And at the coupon rate of 5.8%, it is actually only $280 million. So you are selling it at this point, if you're selling at $340 million, when you're comparing it to present value of that future cash flow, it actually looks really, really good, particularly when you look at what could you make in a government bond at that same maturity, and you're looking at somewhere in the low threes, whereas you are looking at your annual return on this product somewhere in the 10% range, 11% range, because you're being paid back a mixture of principal and interest in this. And at the end of that time period, your yield to maturity is about 5.8%. There are many, many investors who are not necessarily like you and me, but many, many investors who would actually find this to be a more attractive option than being in the stock market with all of that uncertainty, especially when you look at the quality of the borrowers in this portfolio. And this is a portfolio of seasoned loans. The average weighted seasoning of this portfolio is 21 months, meaning that the average note in that group is people that have already been paying and are current on their balance, and they have been for 21 months. This loan pool contains a weighted average credit score of 754. That's amazing. Additionally, the loans have a weighted average borrower income of $162,390 and weighted average borrower monthly free cash flow after expenses of $6,230. This is probably one of the healthiest loan portfolios that you could probably have in an asset-backed security. So this is absolutely a AAA rated security at this point, based on Morningstar ratings, based on S&P ratings, and at least one or two other organizations. But like I said, the weighted average seasoning per tranche here is 14 months in the 24 month, the average 24 months of maturity, or in the 84 month or 7-year note range, the average weighted seasoning is 28 months. So these are notes that are current, that people have been paying on for quite some time. And I think that's actually pretty cool. So if you look at each sort of slice maturity here, it's all north of $6,000 per month, and it's actually really high in the 24 month range. Weighted average credit score for each tranche does not go below 750. Actually, 754 is the lowest. And I think that the lowest single credit score in the entire portfolio was 669. And there was no loans in there where the borrower had a credit score of lower than 669. So I think that is actually pretty impressive in terms of an issue. And look, guys, this looks really different than a lot of other asset-backed issues that are coming out right now. The market for asset-backed securities or collateralized debt obligations has actually been pretty bad now for the last 3 years because of the fear of recession and because of the fear of some sort of repeat of the subprime mortgage debacle, where the risk metrics were not really properly understood, and borrowers that were deemed to be credit worthy in the past, like in the 2008, 2009 timeframe, they really weren't all that credit worthy. Meaning that the pricing of the risk was out of whack in that time period. This was pretty much the perfect moment in time for SoFi to end up getting back into this market, and I think it's actually fairly impressive. And so this isn't the first time that we've done this. They did this back in November of 2022. The actual, this one was sold at a slightly larger discount when it finally went to sale, but even then there was very, very little spread in that. And let me see if there's anything substantially different. Yeah, there wasn't anything substantially different in there. Weighted average credit score for the lowest tranche here was about 753. Yeah, roughly the same in that time period. Free cash flow looks substantially similar. Average income looks substantially similar. And the weighted average FICO score looks substantially similar. And weighted average seasoning is a little bit more. So that is, that's pretty good. And if all this goes well, and it looks like it already has, I saw on Reddit that people are actually already reporting that is basically just being that there are underwriting this issue. It has been rated and it's being reported on websites. It has to do with a misunderstanding of what the word pre-sale means. So, so all of that should be coming out. The closing date on this is actually February 24th of 2023. Yep. And then the S&P global ratings of this is the SoFi. So it's going to be listed as SCLP 2023-1S Trust. And you can pull this from S&P's global global ratings. It doesn't require a membership or anything like that. So, and there was something really interesting in here. Where was this? See if I can find this real fast. If not, I'm not going to bore you guys by scrolling through this, which, yeah. So when we look at, credit score by percentage of the pool, once you get to 670, below that, there is nobody. So everyone in this pool is 670 and above. I think I said 669, with 60% of the pool having credit scores of 740 and above. So 94.08% of the pool being above 700. This is about as good as you get. The S&P Global expected default rate. This is not SoFi's expected default rate. This is S&P's expected default rate. It's about 3.7%. And I think on the original documentation that I looked at came out from SoFi, the expected default rate was 3.7%. So not a huge difference there. When we and it breaks it down to base cumulative default rates that are expected. And if you notice, this is true on everything, that an 84-month unsecured loan, you're probably looking at a total default rate of about 6%. And the initial pool of 84 months, that's only 14% of the portfolio. This looks a lot worse when you are looking at something like mortgages, right? Those have a much higher default rate, and the low interest rates we've been seeing for the number of years have not been reflective of the actual risk involved with the actually issuing a mortgage. Has everything to do with how easy it was to collateralize these. I'm sorry, not collateralizing them, but turn these loans into securities and get them off of your balance sheet. If that market were to collapse entirely, you're probably looking at a massive tightening of lending standards. So anyway, really dense subject, guys. Not going to cover this anymore because I can feel people's eyes glazing over on this live stream while I talk about this, and I haven't gotten any questions about it. So I'm going to go ahead and click out of these screens real fast. But go ahead and fire away with any questions. I do have a question from Shula's Joe. Do you think, hi, Jason, do you think that SoFi could be a top 10 US bank by 2030? No, that's not going to happen by 2030. I don't know that there'll ever be a top 10 US bank because remember, they're competing with really large investment banks like the Goldman Sachs kind of group, JP Morgan, Morgan Stanley, those guys, the giant investment banks like that. I do think they're going to dip their toes more and more into investment banking. And I think that their lowest hanging fruit is going to be pretty close and pretty soon in the future is going to be underwriting issues from people that are already in their financial services network. So you saw that spread, that 99.999, whatever that was on the issue. Basically, they're going to be issuing or underwriting the issue, or at least being part of the consortium of banks that underwrites issues for people in their financial network going forward. That's going to allow them a relatively high source of income for them. And it's something that's, like I said, is going to be easy pickings for them because people are already doing business with them. They're trusted and that sort of thing. And let's remember, Anthony Noto does come from that investment banking background. And I just wouldn't be surprised at all if we start seeing moves from them in the investment banking space here coming relatively soon. They've already got about 3/4 of the steps covered in which they can do in that entire process, going from originating the loans to issuing the securities and selling them. 3/4 of that they can do all by themselves on any one issue right now. And I believe that regulation would prevent them from doing 100% of that process. But I would be very excited for them to end up becoming an investment bank that ends up becoming part of a consortium that underwrites bond issues. It's a really boring subject, but it's an incredibly, incredibly lucrative part of being in business. So, but no, I don't think they're going to be a top bank by 2030. That's only 7 years. I think maybe by 2040, that's entirely possible. Yeah. So anyway, I wish I was able to share this article off of some point, and now it's no longer available from TipRanks. So the issue that we have right now with Toast. Let's talk about Toast's earnings, and I'm going to talk about that live on the air. I haven't actually looked at these, but I did predict a bit of an outperform, and I did predict that full year earnings. I believe that I predicted they were going to be somewhere between $275 and $300 million for full year of 2022. Let's check and see if that was actually true. And let me see here. I said that loss was going to be between 275 and 300 million. What is loss? Let me see here. Annual rate of return. All right, this is then all other things here. Service models, hyper localized, fourth quarter results. All right, thank you. Fourth quarter results. Total revenues in line with expectations, right at about $769 million. A large portion of that coming from subscription services and financial technology solutions here. They are our annualized recurring run rate. This is their annual. This is basically what they get from recurring revenues is about $901 million here. Their locations increased sequentially from 74,000 to 79,000. This is really great. We have Yavuz reporting from restaurants in France that they are quite happy with Toast. And Toast owner being a restaurant for 23 years. I've been using Toast for the last 3 years. It's the best POS system by far. So I actually had a hard time getting people that I interviewed for that video that I did on Toast to tell me why it was exactly that they thought that Toast was the best system. Most of them had really personalized answers for that, and I was a little bit disappointed. They didn't have anything substantial. Sustained GPV growth. I forget what GPV was in here, so I don't know what that is. So I'm looking for profit and loss numbers. Rapid gross profit expansion. So they lost about $35 million for the quarter, which is, of course, that's good. So declining losses at least since Q2 of 2022. Adjusted EBITDA is, of course, basically 2.3% at this point. They're really close to profitability. And where is the raw number on total year loss? I may have to do that when we're not live and I'm not quite so nervous. Nothing about this like jumps out at me. Nothing about this report jumps out at me as immediately bad. It's basically showing sequential improvement in their business, not exponential improvement in their business. And that's good enough for today. And I did state in the video that the restaurant industry is one of the few industries where macro headwinds in terms of their particular business have really been behind them, that restaurant business has actually just grown over the last year or so. Then there hasn't been really any fear of that declining as of yet. So I am a little bit concerned here that their profit and loss for the year is not just really, really obvious. So, I'm going to take a look at that a little bit later. Okay. So this is actually not going to be sort of a full-time broadcast today. I do have basically which is Teaching Academy. And I want to talk about BYD here. BYD is something I haven't dealt on in a while. It is something that I am paying pretty close attention to, though. BYD has absolutely trashed Tesla in China right now, and they're outselling them in China, and it's by a wide margin. And that wide margin is actually increased. So they increased their sales in China at least by 62% year over year. They sold 150,000 new energy vehicles. Half of those were actually battery electric. So 71,338 vehicles that they sold last month were battery electric vehicles, and that was a 54% increase over year over year. So I think one of the reasons they're doing it, of course, is because they have a much wider lineup of electric vehicles that are available in China. Their cars are actually designed for the Chinese market, and they have I think it's the Auto, the BYD Auto, that the base model is selling for like $20,000 at this point. It's got a range of about 260 miles. It's a hatchback. It seats for, like I said, a hatchback seats for 260,000 or 260 miles. It's really weird when I say that, but most license plates if you want to drive a internal combustion engine vehicle, and most of those cities give you a free license plate or a low cost license plate if you buy an electric vehicle or something what they call a plug-in hybrid electric vehicle. So there's a huge cost savings over going with one of their electric vehicles in most major cities in China right now. And there's also a pretty large incentive in terms of a tax incentive there as well. And this is one reason why BYD is doing it side of the country. Something else that I posted on my Patreon earlier today was a picture of a vehicle that I saw on my drive to take my son and my daughter to school this morning. And it was a JAC Frizon, which is a mid-sized truck produced by the Chinese manufacturer JAC, which is the partner of NIO. It had Mexican plates on it. It is not the first one of those vehicles that I've seen here, but it is an indication that the Chinese-made vehicle, the JAC vehicles, are becoming more and more popular in Latin America. I don't have any information on actual number of sales there, and my information is anecdotal at this point. Even though I did post evidence, I posted a picture of the video a picture of the vehicle that I saw. But since I haven't had time to block out the license plate, I'm not going to post it publicly here on the YouTube channel. And then I also posted a picture of a Lucid that I saw driving around here too. So Southern California is absolutely filling up with vehicles that are non-traditional. It's filling up with EVs. It's filling up with Chinese vehicles that are being sold in Mexico. And I don't know. And if you're not from here, San Diego basically is one of the or San Isidro rather, which is the main border near San Diego, is the largest border crossing the entire planet. I wouldn't be surprised if there's 100,000 vehicles each day that pass through the two main border stations here in Southern California. into San Diego County. So I do get to see a lot of vehicles that are not available here in the United States that are sold in Latin America, though. So anyhow, not getting a ton of questions today, but I did want to go here. So vehicles that are being sold are the BYD Yuan, the the BYD Chin, and the BYD Han family of vehicles, BYD Tang family, all of the BYD Seal, plug-in hybrid BYD Frigate, and plug-in hybrid BYD Model X and the Model S, but those are not being made in China at this point. I could be wrong on that, though, but I believe that is true, that the X and the S are not being made in China at this point. So, yeah, and Charlie Munger says BYD was his best investment at Berkshire Hathaway. It's almost ridiculous how much is beating Elon Musk's Tesla. Okay, there's a lot to unpack with that statement, and I'm not going to do it live because I haven't read through this article and kind of picked apart those statements that well. But he really was just bringing up lead in BYD and how much that investment has paid off. They basically, what did they buy? They bought a stake for about $230 million. And at one point, that stake was worth about $9.5 billion. It's declined about 30% since then. And they've started selling out of that. And like I said, guys, these guys are value investors. When they think something has reached full value, they're going to sell. They may end up buying the hold on a second here. They may end up buying the stock back at a lower price here, at a lower price later on, but they are value investors. Will the additional SPR release have any effects on oil prices? The original Strategic Petroleum Reserve release didn't have that much of an effect on oil prices. It's mostly psychological. And that's one of the things that a lot of folks don't understand about the Strategic Petroleum Reserve. It is not something that's around there for war. It's not there for conflict or supply interruption. It's really there as a psychological tool to keep oil prices relatively stable. Am I happy that the release was done when it was done? Yeah, I'm happy that it was done when it was done because it did help psychologically stabilize markets. The reality is we've seen production capacity increase only slightly in that time period. We have seen supplies go up because demand wasn't what it was expected. But no, I don't think it's going to have a huge effect on oil prices, even though 500,000 barrels a day have been taken off the market. I think Texas alone has production capacity, refining capacity of about 5 million barrels per day. California has refining capacity of about 1.8 million barrels per day, which is about what it consumes, 1.8 to 1.9 million barrels per day in terms of oil. And I think an additional release is probably not going to have that much of an effect. So what is the most common EV that you see in California that's not a Tesla? Man, I think it's kind of a tie right now between the Hyundai EVs, the Kia EVs, and I'm seeing more and more VW EVs at this point. I've only seen, like I said, a couple of Lucids and got a picture of my first one in the wild last week. And then that JAC vehicle that I saw today, that one was not an EV, but they do offer an electric vehicle version of that one, which I'm very encouraged to see that as well. Yeah. So, very interesting. Anyway, hoping you guys checked out my videos earlier this week. I did one on Upstart earnings and I did one on Toast. And Yavu says, my opinion is that Toast is going to grow in the next 10 years for sure. Just wanted to share and send a restaurateur. I do own Toast shares. Like I said before, I own a bar and restaurant too. It's something I mention occasionally on my channel, but I don't really talk about in depth because I'm not the expert in the restaurant industry. I have a partner who knows everything, and I'm just an investor. But I have noticed that almost every restaurant owner that I know is using Toast at this point. That by itself is relatively meaningless. But I do like the company fundamentals. I do like the sequential growth that I'm seeing. And I also like the fact that it's a SoFi customer as well. They're using Galileo technologies to do to facilitate a lot of their involvement in the fintech world, which is good for SoFi as well. Whatever is good for Toast is going to be good for SoFi as long as they're a client of Galileo financial technologies. And so that's one of the things I wanted to cover. I'll probably do a more in-depth look at Toast's their earnings presentation that they just had. I haven't listened to the call or anything, and I kind of feel bad that I tried to do it live on the air. It's not something I would normally do. Anyway, guys, I'm going to call this one today. I'm going to just do this a really short. I thought I was going to talk a little bit longer. I have a few more questions on the fixed income angle, and that'll happen. I'll be back on Tuesday to cover more. And let's remember that the market is actually going to be closed on Monday for President's Day. And I will see you guys this weekend. I'll try to have another video out this weekend as well. Thank you very much for attending today, and I'll see you next time.